Hi, Mike. Welcome to the Power Talk Show powered by Business Talks Weekly. Thank you so much for accepting our invitation and joining our channel today. I would like to start our conversation by understanding why cash flow, Mike.
Yeah, well, first of all, live from San Antonio is Cashflow Mike, right? So,
Yeah.
why Cashflow Mike? It was a nickname given to me by bankers, right? I teach at the Graduate School of Banking at the University of Colorado. Well, while I was walking down the hallway one day, that's basically what they said. Hey, there goes Cashflow Mike. I said, well, wait a second. Why'd you guys call me that? It's because you never talk about profit. You only talk about cash. And I'm like going, well, yeah, I can't spend profit, but I can spend cash.
What exactly does it mean for our audience? It will help us because I read you help find corporates find the hidden money. So if you can elaborate more on that.
Yeah, so I built a program called the Clear Path to Cash, which I outlined and detailed in my book called Don't Be a Dumb Business Owner. And dumb, yeah, and dumb doesn't mean unintelligent. It means I don't understand my business. So that's basically what we're trying to do is give people small tips, tricks, and traps to avoid on how to maximize cash in their business. And it's just simple little math equations that I come up with to help a business owner actually put more cash into his pocket, not worry so much about profit, but worry about what money is there to deploy, to grow, to put in your pocket, whatever you want to do with it.
Okay, makes sense. So how if I understand how does it help a corporate? If you look at the balance sheet, is there any tool or is there just calculations to it?
Well, yeah, I have an app, right, called the Clear Path to Cash that does a lot of the work for you. You put in some numbers from all three financial statements, the income statement, the balance sheet, and the cash flow statement, and it does a lot of analysis. But let's go with that, right? So I built this technique called the home run financial system. And what the home run financial system is six calculations that touch all the bases, right? So think about baseball and a home run, and they go around the circle. But these six calculations take a little bit from the income statement, a little bit from the balance sheet, and a little bit from the cash flow statement. And I'll kind of explain what that means. So, to me, the income statement is the one that we all kind of rely on, right? It's the one that we all kind of lean on, like, oh, that's our report card. I did good because I got a good income statement. Well, here's the thing about the income statement it's only going to tell you if you had a good or bad day, right? Or month or year, and then it starts over, but nobody can really explain how it gets to start over. Like, oh my God, I had a bad January. Don't worry about it. We'll get them in February. Well, the way it starts over is that the result, whether it be a profit or a loss, gets put onto the balance sheet, right? It gets put onto the balance sheet in the form of retained earnings. If you've ever seen retained earnings on a balance sheet, that's the culmination of all of your profit and loss through the history of your entire company. And the balance sheet is the one that is that. It's the result of every decision you've ever made. What you bought, what you own, what you owe, it's all there on the balance sheet. Anybody that knows how to read a balance sheet knows exactly what's happening in your company over the history of the company, right? And then the cash flow statement, nobody pays attention to. Nobody even looks at it. Why? Because they don't know what it means. Well, it means it's the tattletale of the business. And tattletale means it's going to tell on you, right? Anybody that knows how to read a cash flow statement knows where the money came from and what you did with it, right? You can't, no matter what story you tell, the cash flow statement is going to tell them exactly what happened.
That's interesting. Mike, do the same mechanics will work on a personal finance management perspective? But because this is all related to corporate and a business finance, but can the same mechanics work for an individual managing his own finance?
It, I have people ask me that all the time, and I'm like going, you have to realize that your business is just another investment, right? You can invest in another company in the stock markets. You can put it into a bank account. Your business is just another one of the investments. So you incorporate it into your personal financial statement and manage it like you would any other investment, whether it be a bank account or a retirement account or IRA, it doesn't matter. You should manage it the same way as part of your overall personal, financial statement.
Okay, makes sense. So, Mike, in that case, what is the best financial advice would you give to an entrepreneur, managing his business cash flow as well as his personal finances?
Yeah. So a couple different things. One is control what you can control, right? Because if you're like me, I fight battles that don't even exist. I'm trying to, avoid any type of things that could hurt my business. And sometimes they're not even there. They're just made up in my head, like, oh, that could happen and hurt my business. So I'm fighting a battle that doesn't exist. So control what you can control. The other thing that I tell people about is there's a concept called the financial gap. And the financial gap is the difference between money coming in and money coming out in time, right? how long it takes money to come into your business and how long it takes money to leave your business. The difference between those two numbers is the financial gap. So, and if you think about a gap, it's easier to jump over a small gap than it is a large gap, right?
Yeah,
So,
makes sense.
so you want that gap to be small. That means you want to collect faster, maybe pay a little slower to make that gap smaller. The smaller the financial gap is in your business, the less money it takes to run it, right? And believe it or not, it doesn't matter what size of company you have, but it takes less money to make it run smoothly when that financial gap is smaller.
Absolutely makes sense. Mike, I would like to shift the conversation to the tech part. There's so much advancement in the fintech space, and we have AI coming into the picture. How do you see both collaborating together help corporates as well as individuals to manage their expenses, their finance?
Yeah, I think it's really interesting right now, right? And the problem with AI, from my perspective, is it can take a large amount of data and make sense of it, right? Even if you're reading stuff that don't make sense to you on a normal basis, if you throw it into AI and says, "Tell me what this means," it's going to interpret it for you so you can make better decisions. Where I get into trouble myself with AI is that it hallucinates. It will tell you things with absolute certainty that are not true. It will make up math equations that just do not work. You're like, oh, wait a second, 2 plus 2 is not 7. I don't know how'd you get that. It's like going, and it will go, oh, you're right, and then it will correct it and still get it wrong. You're still wrong. So be careful when you're doing math and you're getting advice from AI, because it will lie to you with confidence and make you believe it.
But what about the platforms? There are certain platforms, investing platforms. Like I even heard like Robinhood is working on some platform integrating it with AI to make smarter selling and buying options to the stock and investment options. How do you think that will come into play?
I think it makes the decisions you would already make faster, right? So don't leave your basics. Don't leave your belief in what makes a good company a bad company just because AI says it's a good company or bad company. Understand that you still have to do your own work. AI does not equal me. I've got a shirt that says that AI does not equal me. And what that means is it doesn't have your timing, right? It doesn't have your heart. It doesn't have your instincts. You still have to tell AI what to do. It's just not going to do it for you automatically. I mean, it can. I guess you can say, hey, do this when this happens, but you still have to give it that instruction. So I think what AI is really good for is taking, again, a large amount of data and making sense of it for you. Like what you're talking about with like Robinhood, what I would use Robinhood for, if it did this, is to tell me where the resistance and the support prices are. And what I mean by that is when the stock price is rising, where is it getting the most resistance? Where people,
Yeah,
it can't break that threshold, or it won't drop below a certain price because there's a lot of support. People keep buying. So it takes a while to do that on your own, or you have to go buy other software. I think if AI did that really fast, you can go, okay, well, set my pricing alerts when it goes above this or below that, so I can make a buying decision.
absolutely makes sense. Makes sense. As Mike, as a what are the challenges the current CFO is facing, in this financial world as well as in the current market?
Yeah, so I think, hey, there's a flood of them right now, right? So just everybody wants to be a CFO now. And what I'm seeing, and I teach CFOs now, but what I'm seeing is that people want to put everybody in a box, right? They say there's a perfect formula that I have. You do step 1, step 2, step 3, step 4. The problem is every business is fighting a different battle at different times. So you can't put them in the same box. There's a concept that I teach called the burning issue. The burning issue is the problem that you feel. So as the CFO, I have to address the problem that you feel, not the problem that I see. And let me explain that. If you give me a set of financial statements, I'm going to see problems, right? But you, as the client, might not know they exist. I have to actually show you and identify and help you with the one that you feel the most. Like, I don't want to talk about the value of your company if you're worried about making payroll. It's like I have to fight the battle that you're trying to fight, with your emotion, because money is emotional. Money has an energy. It's either got a positive vibe or a negative vibe, right? So sometimes I feel good when I'm doing good, and sometimes I feel bad because I'm doing bad. That's what you have to tap into as a CFO, is connecting the finances to the emotions of cash.
Absolutely. And I have two parts to this question. So as a CFO's role, how important it is, because I believe in certain cases CFO is the one who makes most decisions at a certain level. And there are certain people or certain companies who act as a fractional CFO. Is it necessary to have a fractional CFO, or is it necessary to have a full-time CFO for your corporate company?
All right, so I'm going to defer that to the CEO, right? Because if you look at CFO or any of these other C suite characters, they're all in support of the CEO, right? He's the one that ultimately has to make the decision, report to the board, take the hit, those type of things. So is it a fractional versus? Well, maybe that's your intermediate step because I look at companies that have like 7 to 10 million, they're kind of pre CFO. And pre CFO to me is not really big enough to afford a CFO, no, don't really have that many challenges, but maybe I dip my toe in the water with a fractional CFO to understand how money moves at the next level to get me from 10 million to 20 million, right?
Yeah.
And then when I get to 20, 30, 40, 50, maybe I need somebody full time to make sure that we don't step into a big trap and actually hurt the business. So I think fractional to full time is a dependency on the size of the business more than, I just want it, right?
Yeah, makes sense. So in that case, what are the challenges, a company faces in each level of scalability, like from 0 to 100, 0 to 10, and then 10 to 100?
Yeah, I think when you're talking scalability at that size, I think it comes down to process. I mean, early on, the CEO, the owner, the founder, whatever, he's doing everything. He's the HR person, he's the product person, he's the salesperson, and that role shifts, right? Because now I have to build teams because I can't do as much. I can't hire everybody. I can't build the product on my own. I can't, go sell. I mean, you need to start building a team. So as you scale, that's the biggest challenge I think in scaling is building the right structure to actually support the scaling, right? And not
Yeah.
overloading it with too many top end people, but adding them at the right time, which is I don't hire a VP of sales when I only have one salesperson, right? What am I the VP of, right? Really nothing. So I need somebody that can sell. So I think sometimes we go too early on loading up with top end players,
Yes.
and I think that's what we have to do is scale into growth, but have a plan for the structure. When I hit this milestone, that's when I hit, hire a VP of sales. So maybe you start off with just 5 salespersons reporting to the CEO. Then they hire a director of sales, and then all of a sudden you've got different regions where you take the left half of the world, I'll take the right half of the world, and now I need a VP because I've got 2 directors, each running half of the world. So structure is a function of size. It's about organization of scale.
Absolutely. I totally agree with you. Mike, what changes are you seeing in the trend? Because you have been into the industry for such a long period. Change in trend are you seeing in decision making? As a leader or as a founder, what changes influenced your decisions that time and right now?
Yeah. So if I go back to and I use the terms BC and AC, right? And not in biblical terms, I look at it as before COVID and after COVID.
Yes.
So before COVID, right, people were more worried about scaling, just go sell, sell, sell. And they were more worried about revenue and profit and those type of things. After COVID, people really started saying, wait a second, it's about cash. So the
Yeah.
big shift in the trend was people started managing cash a lot more closely and it became part of the conversation. Cash flow before that was like going, yeah, it just kind of happens. But cash flow after COVID, when you had lower sales coming in, people go, oh, wait a second, cash is really important. It's like gas in the tank. And when that runs low, the car stops. So that's where I think the biggest shift was is that people flip flopped the importance of
Absolutely.
sales, right? Because sales is only a measurement of how much work you did. That's it. You can't spend sales. Gross profit, which is cash, is the big number that you should look at on the income statement, right? That's the only place you can get money to pay for your expenses or put in your pocket is gross profit. So I look at sales as just that's how much work I did now. And gross profit is where I generate cash to do other things.
As you are the cash flow Mike, can you give us certain tips or best practices? How can a corporate company manage the cash flow in cases of uncertainty? If there's a global economic slowdown, global war, How does one manage cash flow?
Yeah, so you've heard of the golden rule, right? In your life, to go treat others the way you don't want to be treated. Well, there's a golden rule in business, and it's expense control, right? And it's the change in operating expense should mirror the change in gross profit. Now, let me say that a little bit more simply. Operating expense is how you spend money. Gross profit is how much money you have to spend. So if I have less money to spend, less gross profit, I should spend less money. And it kind of works like that, right? So when you're watching gross profit and gross profit is starting to decline because sales are slower or otherwise, then you have to adjust operating expense by the same amount. So if gross profit comes down $10,000, operating expense comes down $10,000, and profit remains the same, which means you can make the same money at every sales level if you just practice that. I have less money to spend, I spend less money. I have less money to spend, I spend less money, and profit stays the same. When you don't manage that balance, that's when you start seeing big losses and maybe lose your company.
Wow, that's an interesting overview to look at. Wonderful. One final question, Mike. What is the best financial advice you have got that has changed the way you look at money and the way you look at everything?
Yeah, I think what you have to realize is that everything is a cause and effect relationship, and we don't do that. We put everything in a business in a silo. Here's my sales, here's my cost, here's my ratios, but they all interact and they all touch each other. So what I did was I built a cause and effect chart. So the thing to me was, when I do this, this is what's going to happen next. No one ever asked that question. If I make this decision, what should I expect to happen next? Right? We always just say, I did this because something happened. So the best advice I can give you is stop being a historian of your company. You've already lived that. You already know what happened in history. I need you to be the GPS, which is where are we going next? What are we doing next?
Absolutely. Wonderful insight. Thank you so much, Mike. Thank you so much for accepting our invitation and joining our channel today. It was a delightful conversation.
Hey, I'm really happy that you brought me, and what a wonderful way to meet you. Thank you very much. I appreciate you.
Thank you so much.
All right.